Hello, everyone. I'm going to talk about our rates and credit markets outlook over the next couple of minutes. To begin with, let me emphasize this, that for about 2.5 years, we've stayed constructive on interest rates, and we've had this view that that RBI would cut rates aggressively over 2-3 years, and it is a structural rally in markets. We've also stayed away from credit for a while. So let's review some of it and maybe look into the future as to how things would play out. But broadly, we think that most of the forces which were present when we built this thesis of bond rally about 2 years ago are still in force, and we continue to believe that bonds would continue to rally and rates would be brought down further in next couple of quarters and potentially even next year. Now, why interest rates in India have to come off? We understand that that growth has improved in India over last couple of years. Since 2013, growth has built some momentum. In 2013, on the old series basis, we kind of bottomed at about 4.5. The new statistics, official statistics, talk of about 7% or 7.5% growth in India. But if we were to, because it has large value component in it, if we were to look at the growth through the old series specs, most probably in volume terms, we're actually still growing at about 5.5%. So no one is dismissing that growth has picked up in India, but it's been a lot more disappointing than what we originally would have believed. But the bigger game actually is, in terms of growth, is that the nominal growth, which is real growth and inflation, and that's the growth that we as entrepreneurs or as consumers receive, rather investors receive, that growth has actually fallen off the cliff dramatically. Last year our growth was just about 8% nominally. And to put things in perspective, this would be one of the lowest ever growth we would have received in last 30-40 years. It's a 2 standard deviation away from the median growth that India has seen nominally over last couple of decades. We kind of, as an economy, more used to grow at about 13.5% in nominal terms. Inflation deviates, ranges between 5 to 10% in India traditionally over last 30-40 years. And the growth also moves around 4 to 7 or 4 to 8%. But what has happened, of course, last year is a sharp fall in nominal GDP growth. It has large implication for all of us because Indian productive capacity of entrepreneurs and such likes has been built basis certain nominal growth assumptions, and because it has come off so substantially, it has large implications on various balance sheets. A lot of capital structures, the kind of debt equity that India has, that has assumed a certain kind of nominal GDP growth, and because it has come off a lot, it actually threatens a lot of balance sheet, and which is what we have seen over the last couple of quarters. So many defaults happening, and so many companies actually their interest coverage ratios falling quite substantially. So essentially, the key message on the growth side is that it has improved, but hasn't improved to the levels that a lot of us as analysts had expected a couple of years ago, and which is why this becomes a key reason why in India interest rates still need to come off more and quite substantially from here. Frankly, the capacity utilization in India stays at very, very lowish level, and there are not many forces at work right now which will lift Indian economy or economic growth in a substantial manner from here on, because neither a large fiscal play in the country nor global conditions are there supportive of substantial growth pullback. So that's the piece on growth, which we think would further kind of pave way for monetary easing. But monetary easing would only happen if inflation is quite supportive. And Paul showed a beautiful chart as to how Indian inflation has come off quite substantially. Frankly, in last couple of years, in 4 or 5 years, Indian inflation has climbed down from mid-teens to less than 5%. Yesterday, the CPI for March came out at 483, and it's a pretty good news. But what is more important is to see in the future, and there are big forces at work in India, which a lot of investors and many of fund managers actually ignore, which would most probably pave way for substantial decline in inflation, both cyclically as well as structurally. The most important thing which has happened is that our governments, both the UPA 2 and now the NDA, has turned much more prudent than traditionally how governments have functioned in India. And our fiscal deficits have been coming off the cliff over the last 5-6 years. This year, we would run about 6.5% of aggregate fiscal deficit, both center and state put together, which again would be about 1.5 standard deviation away from the central tendency. And only in last 25 years, only thrice we've run this kind of lowish fiscal deficit. And fiscal has a large play in inflation. Its role in stimulating demand, and finally inflation is substantial. And we think that this would pave way for lower inflation in future. But also more importantly, government's administrative policies have been quite supportive. One such is, of course, MSP, the support price which government announces for cereals. Even in last 2 years, when there has been a substantial amount of rural distress because of poor monsoon, government has not really has pulled up MSP prices substantially. It's actually risen at just about 5% versus 15-20% that we've seen just a couple of years ago. It has again direct linkages with rural wage growth, and finally that has linkages with inflation. So in nutshell, our government policies and the admin policies actually are very, very supportive of lower inflation in future. Second important leg to inflation is the monetary policy, and we've seen India adopting inflation targeting framework. The new framework has come into effect now, and it has large implications, because across the world, wherever, both in emerging markets and developed markets, inflation targeting was adopted, its influence on inflation was substantial after it was adopted. And both in EMs and DMs, we saw substantial decline in inflation rates once this framework was in place. So given that India also has inflation targeting framework set in place now, our sense is that structurally India would see a substantial decline in inflation. This we've been talking for last 1.5-2 years now, and lots of gains are there in the price already in terms of inflation coming off. And how does inflation targeting work? Finally, it actually weaves all policy stakeholders. Why do you think government did not increase MSP when rural distress was there, when lots of important elections were there? Because they know that if MSP rises, that would lead to higher inflation and would lead to tightening rates, and therefore it is actually not really, it would not really benefit economy and their constituents any meaningfully. Similarly, fiscal deficit, why would government accept 3.5% this year, where lots of us actually, including us, actually were of the view that government should actually lift fiscal deficit targets for this year. Again, because it's driven by the big influence of RBI and the monetary policy policies inflation targeting. So net-net, this has had influence in bringing down inflation across the world meaningfully, across various countries, and lots of studies have been done, and we hope that something similar would happen in India as well. The third leg of lower inflation is commodities. Commodities have gone through a big bust over the last 1.5 years, and its effect is already seen in wholesale inflation. It's been in deflation mode for many months now. Most probably commodities have bottomed, but its influence on consumer prices would continue to play if commodities actually start to settle here. So it's a great news for India, both from growth and inflation standpoint. But our sense is that the low commodity prices, low energy prices, all would actually translate into meaningful gains in consumer price inflation in next couple of years. So these are the three big legs that we've been talking for last 2 years, why Indian inflation would come off. And we've broadly got this right, that from 15, 17, 18% of inflation, we've climbed down to 5 already. Lots of people are arguing on the street right now that, look, the inflation is very, very sticky, and it's not coming off. It's not going to come off meaningfully from here. Frankly, 15 to 5 journey has been pretty sharp, and we think that getting to 4 in a year and a half time would be quite easy, given the forces which are at work right now. But what's the condition of monetary policy? Growth elusive, not very strong, and inflation come off substantially and is likely to come off further. Has RBI cut rates enough? Do we have accommodative policies right now? We are skeptical of this view, and which is why in last 2, 3, 4 months, when you heard lots of voices against a rate trade or a bond rally trade, we've stayed put to this idea because when we look at fundamentals, we see the Indian rates are still very, very tight. India's real rate with respect to the deflator. And deflator is a combination of WPI, which is wholesale price, and consumer price. With respect to that, India's rate has been at one of the highest ever rate in last 30, 40 years. Again, reflecting that monetary policy conditions are still very tight. They have eased over last 3, 6 months, but they're still pretty tight for the given kind of demand conditions we have in our country. Even from a CPI standpoint, Indian rates are pretty tight. If you were to look at the difference between 10-year bond and CPI over last year, you would still see it hovering around 2 to 3%. Relative to what Paul talked of, that the new inflation, new real rate in US could be 0. It could be actually negative for Europe. And in India, we've actually, you see the chart here, and you see that, these rates have been pretty low in the past. Relative to our history, these rates are very, very substantial and quite costly for Indian balance sheet, so to say. And which is why, you don't see lots of corporate, coming out of stress because our rates have stayed very, very tight. So answer to the question that are rates still tight, though lots of people will make you believe as if, rate easing has run its course and it's over, we continue to kind of stay put to this idea that India is still part of, is going through a big rate easing cycle, and we are still in the middle of it. This is about repo rates and 10-year bond rates, which is about market. But what has happened in India, and unfortunately, is that whatever little or whatever that RBI has cut has also not transmitted into the market. So financial conditions for you as borrower or a corporate as a borrower stays very, very tight. Your PLR rates of most of the banks stays much, much away from the troughs that we saw in 2003 and 2009. Whereas our economic conditions are very much like 2002, 2003. So from a home loan point of view, I actually borrowed money from Standard Chartered Bank for 10-year fixed rate in 2003 or 2004, I think, at 7.5%. I'm a much improved credit today. I would still borrow most probably at 10, 10.5 or 11. If I were to borrow from a bank for 10-year fixed. So in a sense that vis-a-vis what we saw in 2003, which actually led to a substantial recovery in Indian economy during 2004 and 7, our rates are very, very tight right now. So low interest rates, rates have been lowered, but still very tight from a market standpoint. The financial conditions are actually, they have not been able to channel this into lowering rates for the economy at large, and therefore the financial conditions stay very, very tight. And then finally, because financial conditions stay very, very tight, the credit growth in India has actually been very, very weak. So unlike, where most of the, like even in China, where the credit has actually boomed over the last couple of quarters, India's credit growth has stayed off vis-a-vis its historical levels. And frankly, inflation is all about credit in the end, because because if the credit has not been created over the last couple of years, since 2010-11, actually we've seen a big bust in credit because of the tighter financial market conditions. It essentially means that most of the inflation gains that we've had thus far will be durable and in long term in terms of its nature. Most probably you will still see rate inflation coming off only because your financial market conditions have stayed tight. So this is what we think of India's macro growth. Elusive, improving, but still not very astonishing. It's still not as per our expectations when we thought of 2013 as troughing out. Most probably we saw substantial recovery. Inflation, a lot of gains have already come in, but a lot of big forces are at place which will pave way for substantial decline in inflation. But then you would hear on street from many participants and fund managers that look, Fed is tightening rates, and therefore would India be able to cut rates meaningfully from here, even if your local economy wants it or warrants it? Frankly, this is a bit of myopic view that lots of people are taking, that Fed is tightening rates, because in aggregate terms, actually there is a substantial rate easing, unprecedented rate easing happening across the world. 2/3 of the world is actually easing rates. Your aggregate 10-year bond rates across the boards have actually fallen, including in US, where Fed tightened rates in last 5-6 months. 10-year treasury has fallen from 2/4 to 170.74 as of yesterday. So there has been a substantial decline in long-term interest rates across the world. So it's a new normal most probably we are living in, and therefore people who are actually taking this view that interest rates in India may have bottomed out are actually taking a very, very aggressive view right now, because it's out of sync in terms of what's happening in the world around you. And you seem to be then thinking that a unique idiosyncratic things will kind of play out in India. Of course, you also know that near 50-60% of the bonds in Europe and Japan are actually now they trade at negative rates. Japan, you get -1 or 2 basis point if you buy, what do you call it, 10-year bond there, and that's true for German 5-year bond and Italian 2-year bonds and so on and so forth. So basically a large 6 trillion worth of bond stock in the world is actually trading at negative rates. So in a sense, if someone is thinking that this world is not conducive for monetary easing, is a bit of stretch in terms of argument. The second point, of course, is that our rates are very, very cheap now, fundamentally vis-a-vis rest of the world. Give you a context of what was, let's say in 2003 or 4 or 5, our inflation differential vis-a-vis US and developed world would be about 2-3%, and that would be the difference between our bond rates and their bond rates. Now that inflation differential rose dramatically during 2007 to 11. But it's come off back to those levels of 2002-04, whereas the rate differential is still at all-time high. So US Treasuries trade at 170, and we are trading at about 7.5. So there is still a substantial gap between, in terms of valuation, we're much, much cheaper. Even from fundamental standpoint, given that the inflation differential has closed out quite dramatically, there is an argument for the bond differential also to close out. So imagine, if FIIs were allowed to participate in India as freely as they are in equity, where would 10-year bond be? And my bet would be that it's going to be sharply below 7% right now. So in some sense, from an outsider standpoint, there is a substantial value. If you were to ask Paul about Indian equity, instead of Indian equity, Indian bond, most probably he would argue that maybe it's one of the cheapest asset that you would have in the fixed income space in the world. Now, given that vis-a-vis rest of the world, where we are placed, appears to be quite conducive for rate reduction, is our macro appropriate to absorb a monetary stimulus? Because lots of people argue that there has been a lot of stress in the emerging market across the board, given that commodities have fallen and their balance sheets appear really, really bruised, both corporate as well as fiscal balance sheets. Unlike that, actually, Indian conditions have improved quite dramatically, So current account deficit, fiscal deficit, and inflation put together, if you were to build an anxiety index, that's come down quite dramatically in India. And so our gains have been the most vis-a-vis, what you see in most of the other emerging markets. So in some sense, an argument that you have a place where both growth inflation warrant you to cut rates, and the global macro is supportive, and relative to rest of the emerging markets, you still have a decent place, or decent position to actually bring down interest rates. So one would then argue that then why did markets not rally? Because in 2015 you had sharp rate reductions by RBI, but it did not transmit in bond yields. So why did it not happen? Of course, one of the reasons there was a bit technical, but more fundamental reason was actually liquidity, that RBI did not supply adequate liquidity to the markets. So it was a bit technical here, but a substantial part of the total durable liquidity that the system requires, RBI supplied it on the overnight window through LAF, and so which actually then did not allow banks to transmit and markets to transmit rates into long-term bonds and base rates. But that problem has been solved. RBI recognizes this problem, and which is why in previous policy, our governor actually promised to neutralize liquidity in the banking system within a couple of months' time through OMO purchases and such instruments. Now, arguably, this policy that we saw in the beginning of April was actually one of the most benign policy from Rajan. From a quantitative standpoint, a substantial amount of stimulus has been given to economy. So, a lot of market got disappointed. Actually, the equity market got disappointed on the day of a 25 basis point rate cut was delivered, because a lot of people anticipated 50. But in a sense, what Rajan did was actually gave almost about 50, if not more, in terms of rate cuts. By promising a neutralization of liquidity, it would ensure that transmission would augment, would improve quite substantially for both markets as well as general borrowing community. So that problem actually, which is of liquidity, which was one of the reasons why rate reductions in repo rate did not transmit into lower bond market rates and lower base rates, actually has been solved. The other problem that you get to sight of many times, and one of the reasons maybe arguably bonds did not rally, and lots of fund managers talk about there's a big demand supply mismatch in India in terms of government bond. Actually, quite the contrary. There is an argument that I will actually propose that there is a huge demand supply squeeze in favor of demand. One, that you had a substantial fall in fiscal deficit over last couple of years. Our fiscal deficit, as I said, is closer to 6.5, but the total borrowed amount from market is just about 4.75% equivalent of GDP. And now, given that RBI has chosen to neutralize liquidity, it would actually supply liquidity to the extent of 1% of GDP by buying bonds. So the net realized fiscal deficit, which has to be funded by market, and this is very technical, it's not necessarily the fiscal deficit, but the amount which is being funded by market actually come off to 3.75. Now that number, if you were to look at it in context of last 20 years, is at one of the lowest ever rates. So the amount of supply of bond in India is come off quite sharply and substantially, and which is why people who are still worried of supply of bond, actually they should be worried of that, where has supply gone completely in government bonds. There is an argument for a complete supply squeeze on the government bond side. The other important thing is the demand shock in government security. One, of course, the ad hoc demand from RBI, which will actually take out near 1% of fiscal deficit from market. But apart from that, what has happened over the last couple of years is there has been a secular rise investors. Insurance companies, just about 8-10 years ago would buy 15-17% of the government bond supply. Now they buy 40%, and next 5-7 years they would start to buy about 45-50%. The same thing has happened to pension funds and many other investors. So there has been a dramatic rise of investors in the bond space, which is actually now taking a lot of float away in terms of the way you would understand equity. That this float is these investors are compulsorily investors, and they have to buy whatever the level be. And therefore, the residual amount which is left for the market participants in ALMs and levered players and mutual funds is a lot less, and for FIIs is a lot less now. So basically, both arguments why markets did not rally last year, there was a malaise in terms of liquidity problem and demand-supply mismatch. Both have been, in some sense, cured by RBI. One, by way of supplying or promising neutralizing liquidity, and two, the choice of instrument for neutralizing liquidity is not going to be CRR cut, but actually is going to be OMOs, and which will actually take lots of supply off the table, and in a sense, then market would be left with very little supply, and therefore there is a case for lots of term premias, lots of premia for the government bond vis-a-vis repo rate to come off. So there are two arguments for bonds or bond bull. One is the fundamental argument that if you agree with me that if the growth is elusive and inflation has been muted, and there are forces at work which will bring down inflation in future, that's a fundamental argument why you should be buying bonds. But then the technical argument is that, given that RBI is going to be a very large buyer of government bond to supply liquidity, and given that banking system after 2010, first time on a permanent basis will get neutral liquidities in terms of, it wouldn't be borrowing on a daily basis from RBI. These has large implications, apart from, of course, the rise of investor argument that I proposed, where the insurance companies and pension funds and such guys who actually are compulsive buyers of long-term bonds are actually been rising sequentially and secularly over the last 10-15 years. And so because they get to dominate markets more and more, it will actually take off the supply completely and would most probably kill lots of volatility in bond space. So net-net, we kind of on the rate side are very bullish. There has been a substantial rally over the last 1.5-2 months, but we don't see an end of it, and you would continue to see over the next 1.5 years, 2 years, lots of gain being made through bonds, long-term bonds particularly. On the credit side, you aware of our position over the last 1.5 years. We've kind of stayed off the credit risk across our portfolios because we started to think very early that commodities were getting bubbly and it would have large influence on credit markets as such, and which is why we started to pair our positions across our funds from liquid to liquid plus to short-term to credit funds and dynamics of the world, pair our positions across credit. It's kind of paid off so far, but the point I want to highlight here is that the macro of credit actually continues to stay very weak largely because of the capital structure of lots of Indian corporate is still not in good shape, and the given kind of price of lots of commodities and the kind of growth that we have in our country, it would not be able to support a lot of these corporates' capital structure in the existing form, and which is why a lot of them will have to take big haircuts in future. So a poor interest coverage ratio, debt equity being very high, stressed balance sheets, and so on and so forth. And general macro is not very conducive. Basically, on the credit side, on the macro front, we kind of stay very cautious. But what has happened simultaneously is that the credit markets have blown up. The spreads have blown up, especially in the last 7-8 months. The spreads have near doubled. The A-grade papers, which were trading at 120-30 basis point, now trades between 250 to 350 basis point over AAAs. Frankly, in last 1 year, when AAAs have rallied quite meaningfully, the A-grade papers have actually, in terms of yields, have risen by 100 to 200 basis point. And of course, there are sectors, particularly in metal, the rise of yield has been substantially more, and which is why lots of funds that you would have invested, which had exposure in such toxic assets, you did have to pay a big price for it. But now, at least generally, one could say that valuations have started to look attractive. So as a fund manager, then you're actually guessing what to do, because macro still not very conducive. But we've started to think whether if valuations are attractive, you could start to look at some of these assets. As I highlighted across our funds, and I think one of my colleagues would talk about it in great detail of how we kind of navigated 2015's turbulence in the credit markets. But essentially what we did is that across the board we kind of pushed or flushed the credit out of our portfolios, and instead built a big government bond as well as AAA bond positions. And so even in a credit fund like portfolios, we actually invested, we chose to get out of 11% assets or 10% assets and instead get into 8% government bond or AAAs. Frankly, what has happened is that those 9%, 10% credit assets, the yields have blown up, and so therefore net realization for you in terms of return for 1 year has been substantially lower than what you would have simply made by investing in AAAs, because AAAs have actually rallied. So 8% AAA assets in last 6 months has ended up delivering 10.5% return versus 10% A asset actually ended up delivering you 5-6% or sometimes zero returns, so to say. So that's our view on credit side. Now, what should investors do? This is a bit tricky because there's a big force, and which a lot of you have to recognize for your investors is in play right now, and which is the dominant asset class for fixed income investors has been either fixed deposits or pension schemes, EPFO and such things. Now FD is actually going through a big, what do you call it? It has a big secular downtrend, so to say. Not in terms of nominal rates, because every rate has come off, but because a lot of PSU banks who used to actually offer you the best FD rates for investors, because they have large asset quality problems and their return on assets have been falling sequentially over the last 4 or 5 years, that has led to, in order to protect their NIMs, they've been lowering their, what do you call it, fixed deposits. So what has happened for a traditional FD investor is that now it earns almost half of what he used to earn just 5 years ago vis-a-vis the call money rate or repo rate, so to say. So FD as a destination or as a place to park your money has actually lost a big sheen. Of course, tax-frees used to be other instrument for HNIs and wouldn't be there next year. Your pensions or EPFO and small saving rates have been brought down and now have been linked to, what do you call it, government bonds. So net-net, the traditional places where most of the fixed income money used to go, is actually not available for investors, and therefore, the only way that a smart advisor and an investor will have to, if he has to earn extra return, he'll have to negotiate with the markets and place his money in funds or something else in the market. But funds remain, of course, the most attractive destination place to be, and place his bets across various funds that we have in the MF industry and optimize return for himself. Just a bit of highlight on the fund side. As Mahesh mentioned, our performance on the equity side has been stellar for the last 3 years. In fixed income, almost a decade-old story that almost all of our funds, near 100% of our funds have been in top 2 quartile, and almost sustainably about 60-70% of our funds have been in top quartile. Across our portfolios, both in terms of AUMs and number of funds. But here, more importantly, I wanted to highlight that lots of investors who kind of go to FDs and such things, how duration or accrual are the spaces, where they should park their money. A dynamic bond fund has actually navigated last 10 years of turmoil, volatility, whatever you may want to call it, because we've seen at least 2 rate cycles. And through this, over the last 10 years, it's earned about 9.5% net return to the investor. So whereas 10-year bond is more or less there only. 10 year ago, your 10-year bond was 7.5. So in a sense, you've been able to net off expense. Also, you've been able to extract extra 2% for the investors. And of course, vis-a-vis the other funds in the same space amongst top 3, top 5 funds, also the difference in our performance versus that of rest of competition is way too large, just about 2% over the last 10 years. But I think the larger point here is in terms of how dynamic kind of fund, which actually deploys both a bit of accrual strategy sometime, but many times duration or active duration strategy, have been able to exploit excess return over FDs. And almost about for now near 10 years, you kind of would have earned about 2 to 3% extra returns over FDs. Even on net of tax basis, in dynamic, you would have earned in excess of 860 returns. So in a sense that it beats any other tax-free that you would have earned over last 10 years. In fact, our performance in accrual fund has been even more stellar. If you had invested in medium term 1, 2, 3, 4, or 5 years ago, your returns have been anywhere between 10 to 11% in retail plan after expenses. A 5-year return will be about 10.75. So in a sense, these funds in the accrual space and dynamic bond fund space and actually have delivered substantial delta over fixed deposits and all our competition. So our sense is that investors should look at these opportunities, and I want to reach out to you because there is a bit of equity obsession in our community, where in terms of investing, because that's where you kind of get that large size. Mahesh would deliver about 20% return for 15-20 years, but a lot of wallet is still parked in fixed deposits and such instruments which actually deliver subpar performance. So a lot of your investors' money got to move into funds in accrual and a dynamic bond fund to get that extra delta. Thank you.